Welcome to the channel. Today we explore why the middle class feels squeezed and what's really driving it. Stay with us. For generations, the middle class has been seen as the backbone of modern economies. It represents stability, opportunity, and the promise that if you work hard, you can build a comfortable life. The idea was simple: get an education, find a stable job, buy a home, raise a family, and slowly build wealth over time. But something has changed. Across many developed countries, millions of people who consider themselves middle class feel like they are running faster just to stay in the same place. Wages seem stagnant. The cost of living keeps rising. Housing feels out of reach. Debt is becoming more common. And many families are discovering that the lifestyle their parents once enjoyed is now increasingly difficult to maintain. This raises an important question. Why is the middle class getting poorer? To understand this, we have to look beyond individual choices and examine the deeper economic forces shaping modern life. The story is not about a single cause. Instead, it is the result of multiple shifts that have quietly transformed the economic landscape over the last 40 years. These shifts include changes in wages, the rising cost of essential goods, the transformation of work, the explosion of debt, the concentration of wealth, and the effects of inflation and financialization. Together, these forces are slowly squeezing the middle class from every direction. Let's start with wages. For much of the 20th century, productivity and wages moved together. When workers produced more value, they were rewarded with higher pay. As economies grew more efficient and businesses became more profitable, workers shared in that growth. This relationship helped build the modern middle class. But beginning in the late 1970s and early 1980s, something changed. Productivity kept rising, but wages stopped keeping pace. Workers continued to produce more economic value every year, yet the benefits of that productivity increasingly flowed elsewhere. This created a widening gap between the wealth created by the economy and the income received by the average worker. In simple terms, the economy grew richer, but many workers did not. The reasons for this shift are complex. One major factor was globalization. As companies gained access to global supply chains, they were able to move production to countries with lower labor costs. This increased efficiency and lowered prices for consumers, but it also reduced the bargaining power of many workers in higher income nations. Manufacturing jobs that once supported middle-class lifestyles began to disappear or relocate. At the same time, automation and technological change transformed many industries. Machines and software replaced certain types of routine work, reducing demand for some traditional middle-class occupations. While technology created new opportunities, the transition was uneven. High-skilled workers benefited significantly, while many middle-skilled jobs shrank or disappeared. Another important factor was the decline of labor unions. During the mid-20th century, unions played a major role in negotiating higher wages, benefits, and job security for workers. As union membership declined over the past several decades, workers lost an important source of collective bargaining power. Without that leverage, wages became more closely tied to market forces and corporate decisions rather than collective negotiations. These changes contributed to a new economic reality. Many workers today produce more value than ever before, but their share of that value has decreased. But wages are only part of the story. Even if wages had remained stable, another powerful force has been quietly reshaping middle-class finances: the rising cost of essential goods. In many countries, the cost of housing, healthcare, education, and childcare has grown much faster than overall inflation. Housing provides one of the clearest examples. For previous generations, buying a home was often the cornerstone of middle-class wealth. Home ownership allowed families to build equity over time, providing financial security and stability. But housing prices have risen dramatically in many regions. Several factors have contributed to this trend: population growth, urbanization, limited housing supply, zoning restrictions, and investor demand have all played a role. In some markets, housing has also become a global investment asset, attracting capital from around the world. As prices rise, the barrier to entry for new homeowners becomes higher. Younger families often need larger down payments, take on larger mortgages, and devote a greater portion of their income to housing costs. For those who rent, the situation is often similar. Rent prices have increased significantly in many cities, making it harder to save money or build wealth. The result is that housing, once a reliable path to middle-class stability, has become one of the biggest financial pressures facing modern households. Healthcare costs tell a similar story. In several developed countries, healthcare spending has risen much faster than wages and inflation. Insurance premiums, deductibles, and medical bills can represent a significant portion of household budgets. Even families with stable employment often find that healthcare expenses consume a growing share of their income. Education is another major factor. A college degree was once considered a reliable pathway to upward mobility, and for many people it still is. But the cost of higher education has increased dramatically. Tuition fees, student loans, and related expenses can leave graduates with large amounts of debt before they even begin their careers. Student debt can delay important financial milestones such as buying a home, starting a business, or saving for retirement. These rising costs create a difficult equation for middle-class households. If wages grow slowly but essential expenses grow quickly, financial pressure becomes almost inevitable. Even families with decent incomes may struggle to build savings or accumulate wealth. But there is another powerful force shaping modern financial life: debt. Over the past several decades, access to credit has expanded dramatically. Credit cards, personal loans, auto loans, student loans, and mortgages have made it easier for people to borrow money and maintain consumption. In many ways, debt has helped bridge the gap between rising costs and stagnant wages. When incomes fail to keep up with expenses, borrowing becomes a way to maintain a desired standard of living. But debt comes with consequences. Interest payments reduce future financial flexibility. High debt levels can make households more vulnerable to economic shocks, such as job loss or unexpected expenses. And over time, debt can transform what might have been temporary financial pressure into long-term financial strain. Another important trend is the concentration of wealth. In many economies, a growing share of wealth is held by a relatively small percentage of the population. This does not mean that everyone else is necessarily getting poorer in absolute terms, but it does mean that wealth is growing faster at the top than in the middle. One reason for this is the increasing importance of financial assets. Over the past few decades, stock markets and other financial assets have grown significantly. Those who already own large amounts of these assets benefit directly from rising prices. But many middle-class households have limited exposure to these assets, or they invest smaller amounts. This means that when asset prices rise, the wealth gap between asset owners and non-owners can widen. Another factor is what economists sometimes call financialization. Financialization refers to the growing role of financial markets, institutions, and motives in the overall economy. In practical terms, this means that more economic activity revolves around financial transactions, investments, and asset management rather than traditional production. Companies increasingly focus on maximizing shareholder value, which can influence decisions about wages, hiring, outsourcing, and investment. Share buybacks, dividends, and financial engineering can boost stock prices, benefiting investors, but not always translating into higher wages for workers. This shift changes the way economic gains are distributed across society. But perhaps one of the most subtle forces affecting the middle class is inflation. Inflation is often described simply as rising prices, but in reality, inflation affects different groups in different ways. When asset prices such as stocks and real estate rise, people who already own those assets often become wealthier. But when the prices of everyday necessities rise, food, energy, housing, households that rely primarily on wages may feel the impact more directly. If wages do not rise as quickly as living costs, purchasing power declines. Even if income numbers appear stable, the ability to afford the same lifestyle can gradually erode. This creates the feeling that people are working just as hard as previous generations, but receiving less in return. The transformation of the labor market also plays a major role. Traditional career paths often involved long-term employment with a single company, steady wage increases, and employer-provided benefits such as pensions and health care. Today, work is more flexible, but often less predictable. Gig work, contract employment, and freelance jobs offer freedom and flexibility, but may also come with income volatility and fewer benefits. Many workers must manage their own retirement savings, healthcare plans, and financial planning. This shift transfers more financial responsibility from institutions to individuals. For some people, this creates opportunity. For others, it creates uncertainty. Technology has also reshaped the economy in profound ways. Digital platforms allow companies to scale globally with relatively small workforces. A handful of successful companies can dominate entire industries while employing fewer workers than the industrial giants of the past. This dynamic can concentrate profits and productivity gains in fewer organizations and fewer locations. Urban economic growth often clusters around technology hubs and major cities, leaving other regions with slower growth and fewer opportunities. This geographic inequality can further widen economic divides within countries. Cultural expectations also play a role in shaping middle-class financial stress. Modern lifestyles often involve significant expenses that previous generations did not face to the same degree. Technology subscriptions, childcare services, commuting costs, digital devices, and other modern necessities can add to household budgets. Social expectations around lifestyle, housing, and consumption can also influence financial decisions. When people feel pressure to maintain certain standards of living, even small financial gaps between income and expenses can lead to increased borrowing. All of these factors interact in complex ways. Slower wage growth reduces financial flexibility. Rising costs increase household expenses. Debt fills the gap but adds long-term obligations. Asset price growth benefits some households more than others. Labor markets become more flexible but less predictable, and economic gains become more concentrated. Together, these forces create what many economists describe as a squeezed middle. It is important to recognize that the middle class has not disappeared entirely. In many countries, millions of people still enjoy comfortable lifestyles and economic stability. But the path to achieving and maintaining that stability has become more difficult. The margin for financial error is smaller. Unexpected expenses can have larger consequences, and building long-term wealth often requires more planning, discipline, and financial knowledge than in the past. Understanding these forces helps explain why many people feel that the economic system is changing. It also highlights an important reality. The challenges facing the middle class are not solely the result of individual decisions. They are shaped by structural changes in the global economy, technological progress, demographic shifts, and evolving financial systems. Recognizing these trends does not mean that individual financial decisions are unimportant. Saving, investing, education, and career choices still matter, but they operate within a broader economic environment that influences opportunities and outcomes. The story of the middle class is still being written. Economic systems continue to evolve, new technologies emerge, and policies change. Some of the same forces that create challenges can also create new opportunities. Technological innovation can generate entirely new industries. Global markets can open new pathways for entrepreneurship. Financial education and digital tools can make investing more accessible than ever before. But the key question remains: how will societies adapt to ensure that economic growth continues to benefit a broad range of people, not just a small segment of the population? The answer to that question will shape the future of the middle class for decades to come. Because the middle class has always been more than just an economic category. It represents the belief that hard work, opportunity, and stability can coexist. And whether that belief remains strong in the future will depend on how societies respond to the forces that are reshaping the global economy today. Thanks for watching. If this helped, please like the video, subscribe for more deep dives on money and the economy, comment your next topic. See you in the next one.